to Finance with Medvi, and you've probably heard about the Magnificent Seven, but they're not a group of cowboys, don't get me wrong. These are seven of the biggest and most powerful tech companies in the world that have a massive influence on the stock market. Together, they make up over 25% of the S&P 500, which means when these seven stocks move, the market often moves with them. They lead in sectors like artificial intelligence, cloud computing, e-commerce, EVs, and social media. These aren't just popular companies, they're market-shaping forces. But does that mean you should invest in all of them, or be more careful? In this video, we'll go deep. Not just what these companies do, but real investing insights. Let's break down each one. Alright, we'll go over each of the seven companies: Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, and Tesla, one by one. And for each, I'll give you real investing tips: what drives their stock, what risks they carry, and how they fit into a smart portfolio. Then I'll give you a conclusion with their actual investing strategies, like how to build a simple portfolio around the Magnificent Seven, or whether ETFs are the better choice. Let's dive in. All right, first we have Apple. So, what's Apple's business strength? The company is best known for its hardware, the iPhone, Mac, and Apple Watch, but investors are paying close attention to something else: services. In the last few years, services like iCloud, Apple Music, and the App Store has become the fastest growing part of Apple's revenue. That shift is key. Services have higher margins and create recurring income. Apple also does massive share buybacks, which increases earnings per share and supports the stock price. But don't ignore the risks. Hardware sales are slowing, and manufacturing heavily relies on China, a geopolitical risk. If you're a long-term investor, Apple is often seen as a stable blue chip tech stock with growth and dividends. It's not the flashiest growth play, but it's incredibly reliable and often used as a core holding in tech-heavy portfolios. Number 2, Microsoft. Microsoft is what many investors call a sleeping giant. It quietly dominates multiple areas: cloud, Azure, enterprise software, Office 365, and even gaming, Xbox, and Activision. Its secret weapon, recurring revenue. With subscription-based services, Microsoft brings in consistent income, and that makes it less volatile than other tech giants. Azure is also the second largest cloud platform after Amazon Web Services, and it's growing fast thanks to AI integration. But there are some risks. PC sales have declined post-COVID, and gaming is competitive. Microsoft also trades at a high valuation, so growth might be already priced in. Still, for investors looking for steady growth plus dividends, Microsoft is such a favorite. It balances tech innovation with financial stability, and that's really rare. Amazon. Number 3. When people hear Amazon, they think of online shopping, but most of Amazon's profit actually comes from AWS, Amazon Web Services. That's their cloud business, which powers websites, companies, and even startups. E-commerce makes revenue, but AWS makes the money. That's important to know if you're analyzing their earnings reports. Amazon is also investing heavily in automation, logistics, and AI, all of which could reduce costs and increase long-term profit margins. Risks: thin margins in retail, rising labor costs, and increasing regulation globally. It's also really sensitive to consumer spending. But if you believe in the future of cloud and logistics automation, Amazon is a long-term growth stock. Most investors treat it as a buy and a hold, not a dividend play. Next, there's Alphabet, or Google. So Alphabet is Google's parent company. It's more than just a search engine. It owns YouTube, Android, Google Cloud, and it's making big bets on AI with its Gemini platform. Advertising still drives most of its revenue, especially search ads and YouTube ads. If the economy slows and ad budgets get cut, Alphabet's profits can take a hit, but it also has huge cash reserves and very little debt. That gives it stability. Risks include increasing regulation, especially around data privacy and antitrust issues. Google's also facing growing competition in AI and cloud. That said, it remains a strong long-term investment for people looking for exposure to AI, ads, and cloud, all in one stock. It's a favorite among growth investors who want a cash-rich, diversified tech company. Next, let's talk about NVIDIA. So let's talk about the hottest stock in the AI world, NVIDIA. So NVIDIA makes GPUs, powerful chips used in gaming, data centers, and most importantly, AI training. Companies like Microsoft, Meta, and OpenAI all rely on NVIDIA's chips to buy their AI models. That's why NVIDIA's revenue has exploded, especially in its data center segment. Its profit margins are so high and demands keep growing, but the biggest risk here is valuation. NVIDIA stock has gone parabolic, meaning it's priced very high compared to its earnings. Also, chip demand can be cyclical, and competition is heating up. NVIDIA is often treated as high growth, high volatility play. It's great if you believe in the long-term AI trend, but be prepared for sharp price swings. Next, we'll go on to Meta. Meta owns so much stuff. For example, Facebook, Instagram, and WhatsApp. And together they dominate global social media. Most of their revenue comes from ads, especially Instagram Reels and Stories. The company is also leaning into AI to improve ad targeting and content recommendations. In 2023, Meta made a massive comeback after cost cutting and focusing on profits again. The risk? Mark Zuckerberg's big bets on metaverse have cost billions, with little return so far. But plus, Meta faces global criticism and legal scrutiny over privacy and social impact. But if you believe in AI, enhanced social media and targeted ads, Meta has one of the strongest digital ad machines in the world. It's a high-risk, high-reward play with explosive upside potential when managed well. All right, last one. Tesla. Tesla isn't just a car company. It's an energy, software, and robotics company in disguise. Its EVs dominate the US electrical vehicle market. And it's expanding rapidly in China and Europe. But that's not the whole story. Tesla also makes energy storage systems, solar panels, and it's investing in self-driving AI. Its vertical integration means it controls everything from battery production to software updates. Still, risks are real. Competition from Chinese EV markets or makers, Elon Musk's unpredictable leadership, and frequent price cuts that hurt margins. Tesla is very volatile. Its stock prices move fast, but for investors who believe in the long-term vision of clean energy and self-driving cars, Tesla remains a bold futuristic bet. All right, finally, we have our conclusion. So, should you invest in the Magnificent Seven? It depends on your goals. If you want long-term exposure to the biggest, most innovative companies, these stocks are strong bets. But here's how to be smart. Don't just chase hype. Look at revenue sources, cash flow, and competition. Use ETFs like QQQ or VOO if you want to broad exposure without picking individual stocks. If investing directly, use dollar cost averaging to avoid buying at the peak. Diversify. Pair risky stocks like Nvidia or Tesla with stable giants like Microsoft or Apple. Always remember, even strong stocks can drop short term. Invest with a long time frame. The Magnificent Seven are powerful, but even the strongest giants need smart investors behind them. That's you. So I will see you in my next video, and thank you so much for listening. Goodbye.